Hi friends, in this video we are going to discuss about NTA previous year questions from the area of ratio analysis. So this is an important chapter coming under the module of accounting and auditing. Okay, so you can expect a question from this ratio analysis for each and every exam. When you just check it out, the different questions from your exam, you can see there will be definitely a question from this part, that is ratio analysis. We already discussed about other financial statement tools, analysis tools like fund flow statement and cash flow statement in a very detailed video. Now let's move on to the first question. So you can see that this was a question which is asked on October 2020 and that was on shift 2. Okay, so match the item of list 1 with those of list 2 and choose the correct chord from the following. So here you have two lists and the list 2 is saying about the different types of functional ratios and you need to match it with the correct explanation. Okay, and you have the options like this. So coming to the first ratios, you can see the first ratio is current ratio. We can just check it out. What is this current ratio? So current ratio is one of the important liquidity ratio and it's just measure the relationship between current asset and current liability. Okay, so it is just showing a relationship between current assets of company and current liabilities of a company. Okay, so it measures the firm's ability to pay for all its current liability due within the next 1 year by selling off all their current assets. So this is actually measuring about the position of the company, that whether they are able to make their short-term payments on time. Okay, that is actually measured in case of this current ratio. And how can you calculate this current ratio? Current assets divided by current liability. Okay, current assets divided by current liability. So this is our first ratio. Okay, and moving to the second type which is given in your question, that is debtors turnover ratio. So debtors turnover ratio is an activity ratio, or you can call it as a turnover ratio. Here it measures the efficiency with which accounts receivable are being managed. So here the company, or with the help of this debtors turnover ratio, we are measuring whether the company is efficient in collection of its dues from the debtors. Okay, and this is actually about the management of this account receivables. So you can call them as account receivable turnover, or you can call them as debtors velocity also. And coming to the next type of ratio, that is debt to equity ratio or debt equity ratio. Okay, so debt equity ratio is actually showing a relationship between debt and equity. Okay, so the debt to equity ratio measures the relationship between long term debt and firms and its total equity. So this debt means it is about the long term debt. Okay, so you are just comparing the long term debt of the concern and you are just analyzing it with the equity of the concern. Okay, and this is a balance sheet ratio. Why debt equity ratio is a balance sheet ratio? A balance sheet ratio means in which the variables that is used for calculating the ratio, both these variables should be from balance sheet. As you can see that this debt and equity, both these items, we are taking both these items from the balance sheet. Okay, so the items which we required for the calculation of this debt equity ratio is from balance sheet. That's why it is known as balance sheet ratio. A great way for company to measure its leverage. That means it helps to measure whether the company is able to meet its long term liabilities. Okay, whether it is able to pay its long term liabilities on time. That you can be analyzed from the help of, with the help of debt equity ratio. And here you can calculate this with the equation outsiders liability divided by shareholders fund. Simply we are saying debt equity ratio is equal to debt divided by equity. Okay, so here debt means it is actually saying about the outsiders liability and equity is about the shareholders fund. So while you are considering the term debt, you can say that it includes all the liabilities. That means all liabilities that we need to pay to the outsiders of the company. Okay, so it also includes these current liabilities also. Okay, not only the non-current liability but also it includes current liabilities like creditors will be also included in case of this outsiders liability for the calculation of debt equity ratio. Okay, and the next one is interest coverage ratio. So interest coverage ratio, thus all debt has a cost which we normally term as interest. So while we are taking a debt or while we are just taking a loan from a bank, we need to pay interest. Okay, so this the payment that we need to make is known as interest. Normally we are calling them as interest. So if it is a case of debenture, loan, deposits, in all these cases we have to pay some interest. Okay, so that cost is known as interest cost. So this measure the security of this interest payable on long term debt. Okay. So here it is analyzing that whether the company is able to meet these long term like interest payments on time. Okay, so this is a ratio between the profits of the firm available and the interest payable on debt instrument. So here we are comparing or we are analyzing whether we are able to meet this interest cost with the help of our profits. Okay, this is the ratio between the profits of the firm which is available. That means whether we are able to pay off these interest costs with the help of the profit of company. Okay, so see, you can go for the equation like this: net profit before interest and tax, that is very important, before interest and tax. So you can call them as EBIT, that is earning before interest and tax, divided by fixed interest charges. Okay, this is a way how you can calculate interest coverage ratio. And coming back to our question, here we have current ratio, debtors turnover ratio, interest coverage ratio and debt equity ratio. Now how can you match this? So we already discussed that inability to pay interest. If the firm is not able to pay interest, or it is just actually saying about the whether the company is able to pay its interest on time. So with which you can actually match this. Yes, interest is actually you can match it with interest coverage ratio. So A3. Okay, so just check we have any options like A3. Okay, you have two options, option A and option B. Both these are A3. Okay. Okay, now you can eliminate both these options. Anyway, moving back to our question, liquidity crisis. So which of the following ratio is actually measuring about the liquidity position of the company? That is actually by this current ratio. So B1 again, B1, yes. So B1, so your answer will be option A. So you can see there is only one option with B as one option. Okay. So if you know that current ratio is related to liquidity crisis, you can directly go for the correct answer. Anyway, let's check it out the other one. Then inefficient collection of receivables. So when we are saying about the receivables and all receivables management, all these will come under debtors turnover ratio. So C is 2. And finally, return on shareholders fund being higher than overall return on investment. So here we are making an analysis between the shareholders fund and your investment. Okay, so that you can connect actually with the debt equity. So that's a remaining option. From it you can go for a option 4. Okay, so A3, B1, C2 and D4. So the correct answer for this question is option A. Moving to another question again, which is in October 2020, shift 2. Okay, so when current ratio is 2:1, an equal increase in current asset and current liability would result in. So it is given that current ratio is 2:1. So you have to identify whether there is an equal change is happening in both current asset and current liability. Will this current ratio will change or increase, decrease, or will it become double? Okay, that's a question. I know that most of you will go for the answer like it will increase, because in your question it is given that current asset and current liability is increasing. So in such a way that most of you will go for the answer to option B. Okay, anyway, let's check what this current ratio is. I already mentioned current ratio is the relationship between current asset and current liability, as you can calculate with this equation, current asset divided by current liability. Okay, so moving back to this question, in order to make it more clear, we can just do a problem in connected with this that will give you a more understanding, and we can solve the answer based on that. Okay, so here we have current ratio as 2:1. Okay, that means, what do you mean by this current ratio? Current ratio means current asset divided by current liability. So this is the ratio 2:1. That means current asset is twice that of current liability. And in our question, it is asked that if there is an increase in current asset and current liability, that means an equal increase. Like we can take an example to make it clear. See, current asset, if current asset is rupees 1 lakh, then current liability should be half of this. Okay, that means 50,000. So how this current ratio will be? See, current ratio is equal to current asset divided by current liability, that is equal to 1 lakh divided by 50,000, that is, you can cancel 1 0, here also 1 0. So here we have 10 divided by 5, which means 2. 2 means for ratio you can write it like 2:1. Here 2, here 1. So 2:1 is the ratio of this question. So this is the first situation. Now with this you can find that if there is an increase, that means if your current asset and current liability got increased same amount. So I am just increasing 50,000 rupees in both this current asset and in current liability. Okay, so there is a 50,000 rupees increase in current asset and current liability. So now new current asset will be 1 lakh plus 50,000, that is 1,50,000. And what about current liability? Here also there is a 50,000 increase, same amount of increase. So that is 50,000 plus 50,000, you will get 1 lakh. Okay, so this is an example, you can take any number, okay, that's your choice. So here we just taken this number. So 1,50,000 and 1 lakh is the new current asset, amount of current asset and current liability. Here also we can find current ratio by current asset divided by current liability, that is 1,50,000 divided by 1 lakh. Okay, so here you can cancel 3 zeros, 1 0, here also 1 0, and here 5 3s are 15, 5 2s are 10. Okay, so 3/2 means you can write it as 3/2 means 1.5. So 1.5 is to 1. Okay, so our old ratio were 2:1, and here we made an increase of same amount in both current asset and current liability. Then what happened to your current ratio? Your current ratio become 1.5:1. Which one is more? 2:1 is the greater value. That means by increasing a same amount of current asset and current liability, what happened to your current ratio? It got decreased. That means 2:1 becomes 1.5:1. 1.5 is the lowest value. Okay. Now coming back to our question, when the current ratio is 2:1 and equal increase in current asset and current liability would result in decrease in current ratio. Okay. Now moving on to another question that is asked in December 2018. Given below are two statements, one labeled as assertion and other labeled as reason. Read the statement and choose the correct answer using the code given below. And the assertion is given as a low debt equity ratio is generally recommended for a newly started business, and the reason, during the initial years of business, debt servicing will prove to be less burdensome. See, this is an assertion reasoning question, and this is actually from the area of debt equity ratio. So when you are just checking the different question paper, you can see that there will be a question from ratio analysis. For this exam, 2020 exam, they have been asked from the area of like current ratio, like they have asked different types of functional ratio, and there was a match the following question, and there was an additional question in related to current ratio also. So you should study about these different types of ratios and how can you calculate, that is about the equations and the classification of each and every ratio, that is very important, and this is about debt equity ratio. Okay. And here we have the different options like both A and R are correct and R is correct explanation, both A and R are correct and R is not the correct explanation, both A and R are incorrect and A is correct but R is incorrect. Okay, these are the options. Anyway, coming back to our main topic, that is debt equity ratio. So what is this debt equity ratio? Debt equity ratio means it is just analyzing the relationship between debt and equity of this concern. So debt, we already mentioned that debt includes outsiders liability, okay, that we need to pay to outsiders of the company, and this equity means it is about the shareholders fund. Okay, so the question is, in our question it is given that it's about low debt equity, whether it is given that low debt equity is suitable for a newly started business. See, a low debt equity ratio indicates, so what do you mean by this low debt equity? Low debt equity means lower amount of financing through debt rather than equity. Okay, we are calculating debt equity by this equation, debt by equity. So if that particular ratio is lower, that means the equity is more in comparing to debt, or that means debt is lower in comparing to equity. Okay, so that means they used more equity to finance their fund. Okay, so if the company depends more on borrowed capital, that means this is a situation, if low debt equity means that particular company is depending more on equity than debt. Okay, But what happens if the company is depending more on a newly started business is depending more on debt to capital? What happens? See, if the company depends more on borrowed fund, the company needs to pay more interest or fixed cost. That means they needs to pay fixed cost. Debt means it's a fixed cost. You have to pay fixed interest. Okay. So you need to pay a fixed cost. That is much more difficult for a concern as it is a newly started business, because their earnings may not be stable. Okay, because they just started their business, so it is just growing only. Okay, in such a way that they are, or it will become a burdensome for that such a particular firm to pay off these kinds of fixed cost. Okay, so a highly leveraged company suffers if the earnings decline. So highly leveraged company means a company which uses more debt. Okay, a company whose capital structure includes more proportion of debt. So if there is in such a situation, and if the company's earnings is suffering, like if it is declining or if it is not constant in such a way that it will become a huge burden on such a newly started company. Okay. So coming to our assertion, a low debt equity ratio is generally recommended for a newly started business. Yes, that is beneficial, or that is just best decision for a debt equity, because they are depending more on owner's fund. That is safe for them. Okay. And coming to the reason, during the initial years of business, debt servicing will prove to be less burdensome. Okay, so during the initial years means during the startup stage, if they are using like the debt servicing or the ability of their to pay the debt will be much more lower, because they are not able to pay a fixed cost in time. That will be very difficult. Okay, so you can see that the assertion is true. And what about reason? Reason is also true. And for every assertion reasoning question, what you have to do is you should check the assertion is right. Then you need to check about reason, whether it is true or false. Then you should find whether there is any relationship between this assertion and reason. That is, whether this reason is supporting the given assertion. Yes, this is saying about that a particular newly started business should go for low debt equity ratio, and here it is, this statement is supporting your assertion. So you can say that both A and R are correct, and R is the correct explanation of A. So the correct answer will be option A. Okay. Now another question on July 2018. So this is also an assertion reasoning question, and the assertion is a high operating ratio indicates a favorable position, and the reason is given as a high operating ratio leaves a high margin to meet non-operating expenses. Okay, so this is also a assertion reasoning question, and you have the different options in connected with this. So you should know what is this operating ratio is all about. Operating ratio means it is showing a relationship between the cost of sales, or the cost which is related to selling a particular product with the net sales of that particular concern. And while considering about this operating ratio, we are taking operating expenses, and this operating expenses will include all those expenses like administration, office expense, selling and distribution, salaries, and even depreciation on asset will be also included as an operating expenses. And see how you can calculate this operating ratio. It is by cost of goods sold plus operating expenses divided by net sales multiplied by 100. So if you want to convert into percentage, you can multiply it with 100. So cost of goods sold means COGS means cost of goods sold. So cost of goods sold means the cost that you have incurred for selling that particular item, and all those operating expenses will be included here, divided by net sales. Net sales means sales less sales return. Okay, so this is the way how you can calculate operating ratio. And if this operating ratio is high, what do you mean by that? If operating ratio is high means the numerator part is more in comparing to the denominator part. For an equation you can say like that. Okay. So this numerator part is actually saying about the expenses. So in comparing to the expenses, or if operating ratio is more, it means that the numerator part is more. If the numerator part is more, that means your expense is more in comparing to your sales. Sales means the return that you are getting by selling your product, right? So your expense is more in comparing with the net sales. See, is that good for their concern? No, because they are incurring more cost, okay, and they are not able to get or they are not able to get or manage a sufficient return from that particular expense. And if this operating ratio is lower, that means their operating expenses or their various expenses is lower in comparing to their net sales, or their expenses is comparatively lower. So that is beneficial for concern. Okay. Anyway, see, a higher ratio would indicate that the company's ability is inefficient because it is not able to meet its expenses with the help of the return that they are getting. Okay. And a lower ratio would consider to be a good sign as the company's expenses are less than that of its revenue. Okay. While making a comparison, expense is much more lower in comparison to the revenue. So, high operating ratio means less margin to meet non-operating expenses. So, if you have high operating ratio, you are using your most of the part from this net sales for paying this operating expenses. So, it is very difficult to meet your non-operating expenses. Okay. Anyway, coming back to our question, the assertion is a high operating ratio indicates a favorable position. Is that right? No. A low operating ratio is better for a concern. So, the first statement itself is wrong. It is not going to give you a favorable position. It is about an unfavorable position. And what about reason? A high operating ratio leaves a high margin to meet non-operating expense. See, if your operating ratio is high, that means you are not able to meet your non-operating expenses because you have to incur whole your revenue for paying this operating expenses. So, there is no such remaining amount in order to meet this non-operating expenses. So, both these statements are actually wrong. So, yeah, we have only one option that A is incorrect. In all other options it is given that A is correct. Anyway, both A and R are incorrect and the correct answer for this question is option C. Next question on November 2017. See, this is again an assertion reasoning question. So, you can expect more question like assertion reasoning question, match the following question from the area of this ratio analysis. Okay. So, assertion is given as debt equity ratio indicates the long term solvency of a company and reason is given as it measures the ability of the company to pay off its long term liabilities. So, again we have the same options as we discussed earlier. So, coming back to this debt equity ratio is showing a relationship between its debt, that means the amount that they need to pay outsiders liability and the shareholders fund or the total equity. As we already discussed, it is a type of balance sheet ratio and this is actually measuring the leverage position, that means whether they are able to meet their liabilities on time, long term liabilities. If it is about short term liabilities, you can say it is about a liquidity ratio. Okay, if it is about a long term liability, it is about leverage ratio, that is debt equity ratio is actually a type of leverage ratio. Okay, so the assertion is given as debt equity ratio indicates the long term solvency of a company. Solvency and leverage, both these are same. Okay, so a debt equity ratio is actually saying that whether you are able to meet the long term liabilities of your concern in time. So, yes, that itself is showing solvency is also solvency and leverage, both these are same. And what about reason? It measures the ability of the company to pay off its long term liabilities. Yes, that is actually measured. So, you can say that assertion is correct and reason is correct, and reason is actually the correct explanation connected with your assertion. Okay, so the first option itself, that is both A and R are correct and R is the correct explanation of A. Okay, that is option. So, in this video we have discussed some of the important questions. We included 2020 questions, 2018, 2017. So, you can see a number of questions from the area of ratio analysis, and that is a very important area as we are seeing questions for every time or in every exam you can see one question from this ratio analysis, and this time they have been asked 2 questions from this area. So, see, this area is very important. Please give importance to that area. So, I hope this video will help you for your preparation of Nta Ugc NET and JRF. Happy learning. Thank you.